There were corruption scandals, therefore permissions started getting delayed a lot. They were building NPAs in the financial system.
Today, we talk about India's strong, stable banking sector. But there was a time when 1 in every 6 loans had collapsed. That journey from the brink of crisis to global stability is what we are breaking down today. India's long and complicated trysts with the non-performing assets, or the NPAs. First things first, our banks and the banking system need to be healthy, meaning they should have sufficient capitalization, adequate liquidity, a diversified portfolio, and most importantly, the ability to lend to deserving borrowers. If any single one of these parameters perform poorly, the entire banking system takes a hit. NPAs, or the non-performing assets, are simply loans where the borrower has stopped paying interest and principal for 90 days or more. To put it simply, the loan is no longer performing its basic job, which is to create income for the bank. It is essentially a bad loan that is sitting idle on banks' books. Banks always expect some NPAs. However, when the entire chunk of credit stops performing, the system enters a crisis mode, and India did enter that crisis. In 1996, the ratio of NPAs to total bank advances peaked at 15.7%, meaning 1 in every 6 loans in India had defaulted. The liberalization of the Indian economy did open markets, but also exposed decades of weak credit discipline. This meant a serious banking crisis. The Narasimham Committee reforms were the first honest mirror India held up to its own banking sector. Then came a breakthrough. The global Basel norms and the securitization and reconstruction of financial assets and enforcement of Security Interest Act, the SARFAESI Act 2002 by the then NDA government. NPAs fell sharply from 15% to about 5.4%. India's banking sector was on a path to recovery. But the stability did not last. The UPA era, characterized by massive bad loans and features such as phone banking, saw NPAs rise again, which later prompted former RBI Governor Raghuram Rajan to publicly attribute the crisis to the UPA era corruption. Banks lent without due diligence. Netas and bureaucrats would often force banks to lend to their families and friends. Goes without saying, this was a disaster in making. The balance sheets were bleeding. Then came the reset. With a change in the central leadership, a call was made to solve this issue once and for all. Going by the age-old adage that sunlight is the best disinfectant, the Government of India, along with the Reserve Bank of India, forced the banks to clean their balance sheets, no matter how disturbing the NPA figures would be. The RBI's Asset Quality Review in 2015 forced banks to show the real numbers, and what came out was shocking. Hidden NPAs had a total banking stress that stood close to 11% by 2018. But for the first time, India had a cure ready. The Insolvency and Bankruptcy Code of 2016 created a transparent and time-bound recovery system. Rupees 3 lakh crore recapitalization strengthened the weakest banks. Mergers brought scale. Ease reforms brought discipline. And the National Asset Reconstruction Company Limited, India's own bad bank, finally cleared decades of legacy stress. And where are we today? NPAs are now below 3%, touching 2.58% as of March 2025. This is not just a story of recovery. This was the complete reconstruction of the Indian banking system. India's banking system is a reminder that growth needs discipline, and the institutions that finance a nation's dream must be protected with constant transparency and constant vigilance.